Hey everyone, welcome back. I'm one of the coaches of Unger Academy, and today we're going to see together the engulfing pattern, which is one of the most famous patterns deriving from classical technical analysis. And according to the trading handbooks, it's also one of the strongest. But before we dive deep into this pattern, I'd like to invite you to please subscribe to our channel, click on that notifications bell so that you don't miss out on all our next videos. Hi, we are the Unger Academy, and we teach traders how to make money in the markets. Our founder, Andrea Unger, had been struggling with trading for years until he developed his automated trading method, which he used to become the only 4-time world trading champion. Subscribe to our channel for free tips and tricks. So let's start our video and see what the engulfing pattern is and how it works. First things first, there can be two kinds of engulfing patterns, bullish and bearish. In both cases, we have one bar whose body, which is the difference between the open and the close in absolute terms, is greater than the body of the bar that precedes it. And as you can see from the dotted lines in this picture, the body of the reference bar totally incorporates the body of the previous bar. We have a bullish engulfing when a red bar is followed by a green bar, so when a bar in which the open is greater than the close is followed by a bar in which the open is less than the close. And vice versa, we have a bearish engulfing when a green bar is followed by a red bar. That's it. In trading handbooks, it's written that this pattern doesn't need any confirmation. However, its effectiveness could be improved if we came from a downtrend in the case of a bullish engulfing or from an uptrend in the case of a bearish engulfing. So let's go and see it on the chart. Here I've highlighted a downward price inversion that indicates a bearish engulfing. And if we removed the highlighting, we could see that this bar has a body that covers the body of the bar that precedes it, which indicates a trend reversal. Now we come from an uptrend, and here there's a downtrend that's about to start. Okay, let's see an upward price inversion now, so a bullish engulfing. Here it is. In this case, we come from a downtrend. Now this candlestick is a green candlestick that indicates the start of an uptrend. Coding this indicator is very simple because the function that identifies the bullish and bearish engulfing patterns are already present in most trading platforms. Here you can see the code that tells the platform how to plot these patterns. Don't pay any attention to all that stuff, which simply tells the machine how to color and plot the bars in the chart. Let's just focus on one of these two functions. Let's go open it, and here we can see the conditions used to identify a bullish engulfing. So we have the conditions related to the close and the open that define the two bars that characterize this pattern. And then we see this other condition based on a simple moving average that indicates if we're coming from an uptrend or a downtrend. In this case, we come from a downtrend, since the simple moving average calculated on the last n periods, len in this case, is lower than the same simple moving average that was calculated 1 bar ago. Alright, so now we're ready to build our strategy and test the real effectiveness of this indicator. This is the strategy, and as you see, it is pretty simple. So here's where the bullish and bearish engulfing patterns are defined. Then before the entry conditions, I added another condition that tells me how big the body of the last bar is. So the body of the second bar of the engulfing pattern compared to the average of the bodies of the last 5 bars. Then I entered a parameter that lets me multiply this value. If we don't want to use this condition, we can simply set body underscore mult equal to 0. And here we see the entry conditions. For now, we will make only long entries because I want to show you how the strategy works on a portfolio of stocks. And finally, here we find the exits. In this case, I've set a very simple time exit after n bars. We'll backtest the strategy using MultiCharts Portfolio Trader. So let's run the test and see what the strategy would have done on our portfolio of stocks. And this portfolio contains some pretty popular stocks that I've picked from the most traded ones that are listed on the NASDAQ. First things first, we'll define the engulfing pattern using 5 as an input for calculating the moving average. We'll also use a temporal exit after 4 days and set body underscore mult equal to 0 to disable this filter. So let's go and backtest the system. And as you can see, the first results we get aren't so beautiful. Yes, it starts to rise at a certain point, but we see that it fell sharply in 2008, and really, well, it doesn't seem to be that promising. It has earned about $80,000 since the beginning of the backtesting period, which started in early 2006. So you see, it doesn't perform very well. The first thing I'd like to do is to try and fix the strategy a little bit, since at first glance it doesn't look very appealing. Let's go and edit the MultiCharts predefined instructions for identifying the bullish and bearish engulfing patterns. In particular, what I'd like to analyze is the effectiveness of the way in which the two bars that make up the pattern are defined. So I'd like to, somehow get rid of this condition. And to do this, we can simply comment on these two lines of code and replicate this part of the code by adding it to the condition. So to the Boolean variables called bull engulfing and bear engulfing. So we're going to replace this piece of code and then the part that defines the last two bars. Okay, so let's compile the strategy and go and see the backtest results again. In this case, we're only going to consider long entries, even if we've just changed the conditions for both the long and the short entries. But as I've already told you, since we're testing the system on stocks, we test the effectiveness of this two-bar pattern only with the long trades. As you can see, the total net profit has dramatically increased and is now 3 times the profit that we had before. The number of trades is about 400, which isn't a large number, especially considering the number of instruments we're testing. However, it's still acceptable since this is a pattern that doesn't occur so often. The average trade is around $500 to $600, which means about 0.6%, because we're trading with positions that have a counter value of about $100,000. So obviously this average trade is not very large. The equity line has improved, especially in this part of 2008 when it no longer loses as much as before. However, even now it goes up. It still doesn't look that great. So what can we do to further improve it? Well, we could try using the filter that we built for the body, so the one that evaluates the significance of the reference candlestick used to create the pattern. And to do that, we could run an exhaustive optimization of this parameter from 0 to 2 in steps of 0.05. So we'll get exactly 41 different strategies. And here's the optimization report. And this time I'd like to show you a graphic version of the results. The purple line represents the number of trades, and obviously it's a decreasing number, because the more strict the condition we use, the smaller the number of trades made by the system. So let me show you that condition again. We need to consider the body that is greater than the 5-period simple moving average of the bodies multiplied by a certain value. So if we multiply the moving average by 2, the system will make less than 100 trades. And of course, if we don't apply the filter, it'll make those 430 trades we've just seen. So back to the results, the green line in this chart represents the net profit. And what's interesting about this line is that it also decreases and somehow follows the trend of the number of trades, which means that the average trade remains more or less constant. So let's take a look at the drawdown, which is represented here by the red line. Now, there's some more turbulence here, but I wouldn't think about it too much, as it could just be a random combination of events, although a pretty unfortunate one in this case. Anyway, these results make me think that this filter can't do much to improve the strategy. And the reason why I've shown it to you is that I wanted to show you a way to search for edges in the markets and evaluate how effective they could be in your strategies. And I'd also like to make a couple of remarks about this pattern, and the first one is about its very nature. You see, to use this pattern effectively, the close and the open need to be separate. And this can only happen in markets in which the close is more or less distant from the open of the next session. So take the crypto market, for example. In that case, the market is open 24/7, so having a clear and substantial difference between the close and the open of the next session will be quite difficult. Vice versa in the case of stock futures, such as the mini S&P 500 future, even if the futures market is open 23 hours a day, we can still use it. In fact, we can simply cut the session of the future and trade it only when its underlying is open. That is when the stock market is open, so from 9:30 to 4 New York time. On the other hand, the second remark I'd like to make relates to how this pattern is built. We've identified the engulfing pattern as a combination of 2 candlesticks. But what about the sum of these 2 candlesticks? What does it produce? Well, it produces a pin bar. And we've already spoken about pin bars in another video. So I'll put that link to that video at the top right of the screen so that you can go and watch it. Now, the trading tip I want to give you with this video is that sometimes it can be very useful to go and analyze these patterns from a different perspective. For example, searching for an engulfing pattern through a pin bar and maybe using a different time frame. I mean, why not? So as you can see, we can start from an idea we find in trading books and explore what we read there in greater depth, breaking the ideas down, testing them in a concrete way, and evaluating their efficacy through numbers. And to do this, we use a method developed by Andrea Unger, the only 4-time world trading champion with real money. And with his method, we managed to run these tests and analyze them very efficiently. And if you want to learn more about how we do that at Unger Academy, well, I'm going to leave you a link below the description of this video, and it'll take you to a completely free webinar that will introduce you to the world of trading systems and give you a general smattering of the systematic approach to the market and how it works. And with that, thank you so much for watching this video. If you want to learn more about other topics, please write it in the comments. And as always, if you haven't done it yet, I invite you to please subscribe to our channel and click on the bell to be immediately updated when new videos come out. Until our next video, stay safe everyone. Bye-bye.